All right. Hi, everyone. My name's PK, and here I've got on the show today Chris Bates from Wealthful. Just to introduce Chris really quickly, he is a mortgage broker, one of the biggest out there in terms of volume of loans, written number 11th in Australia. Is also the host of a great podcast, which I sometimes listen to myself, called Elephant in the Room. So go check out all that. But in this episode, we'll be talking about interest rates. I know a lot of people are kind of super fearful, especially if you're not a seasoned property investor. You're thinking, have I missed the boat? Is this the wrong time to buy? How is the lending strategy in Australia going to affect me? How interest rates going to affect me? How's borrowing capacity going to affect me? Is everyone going to sell their properties? Yeah, I know these are the things that everyone's talking about. So I thought instead of me kind of just waffling on about it using different videos, let me just get an expert on finance, on broking, on lending, Chris, to just sort of maybe dispel some myths or maybe confirm some myths. I don't know. So thank you, first of all, Chris, for making the time.
No worries. Good to be here.
Awesome. So let's just get into it. But by the way, guys, I found Chris Bates on LinkedIn. I really found his posts super insightful. So if you are interested, go follow him there. But the first question I want to ask you is let's just go with the big elephant in the room, but interest rates. What's your take on when interest rates will rise, how much they will rise, and what the impact will be on the national property market? Of course, no one has a crystal ball, and there's markets within markets, so much nuance. But those are the things that people want to know. So if you could share just some insights, that would be super.
Okay, cool. So, I mean, I don't really care when they rise. I mean, they're going to rise at some point, right? So whether it's this year or next year, I'm not that bothered. The thing that really matters is how far do they rise, okay? And do they go from 0.1 to 3%, and then are you paying 5% interest at the bank? That would have a huge impact. So how far they go is the real key question. I mean, you got to be worried about this at the moment. The reason is that, banks are pretty bad at forecasts. They get it wrong every year. But, I mean, the banks are coming out with big fours. Probably the most respected commentator I like out there, Chris Joy, he's called the whole up and down. He's saying big four. So, when people are doing this, they're talking about the whole market, right? And that's the first mistake people are making, is that the market doesn't all move up in the same pace and doesn't fall in the same pace, which most people get, but they don't actually they don't think that through in terms of their portfolio. It's gonna rise. I mean, how far is going to be a bit of a hamstring on the economy? The more they rise, basically, the less people are going to have to spend, the less people will spend, the slower the economy will go. So, you're going to start to see those impacts. I mean, a lot of people are saying that, the RBA is going to go from, 0.1 maybe to 1.25, but I think competition, and that means your mortgage rate, which variable rates on home loans are around sort of low 2%, as long as overseas funding stays cheaper, which is a bit of a risk at the moment, you might be paying low 3% on your mortgage, right? It's not that bad, really, considering as long as you've got a job and you've, all that sort of stuff, that's not really going to impact households, I don't think, And if it goes to 4% or 5%, this is when I think you'll start to see some real problems. But a 1% increase, I don't think it's such a big deal. The first thing most people need to do is just stay on top of their mortgage strategy. I mean, what you get as a new customer versus an existing customer pretty much changes the day you settle your loan. They'll be offering better deals to new customers. And if you've got a loan at the moment, you're probably frustrated. If you look online, what you're getting on your online banking versus what they're advertising, is quite a big difference. So the first thing you need to do is be staying on top of your loan structure. You need to be extending your loan period, because that reduces your repayments, playing with things like interest only, if you're an investor. And so just maintaining your loan structure and being smart there can sort of diminish the wage increase, because your repayments may just stay the same, or if not lower, if you know what you're doing. So it will hit certain pockets, and you do need to be careful. So if you think about it, if interest rates are going up, who's it going to affect the most? People with a lot of debt, right? Or people who haven't got many buffers. And so generally speaking, where people have got a lot of debt are in new house and land packages, for example, because they're all going in with 90% loans, sometimes bigger, and they've all settled in the last 2 or 3 years because it's a brand new estate, right? And so you think about it, they're all got very low debt. They used all their deposit to buy the house. They're probably living, got young families as well, so cash flow is sometimes really tight. one might be working, one not. And they haven't got much buffer because, they've just put everything into the house. And if there is a bit of an unemployment spike or, there's a global downturn as well as increase in interest rates, you could see unemployment rise and those sort of areas would be hit. Also areas where there's lots of investors. If interest rates jump a lot and people can't refinance and they're on principal and interest repayments as well. So areas where there's really a glut of investors like high-rise apartments, those are the type of areas that would be hit as well. But generally speaking, big established suburbs, not every house has got a big debt on it. 30% of properties, maybe even sometimes 40%, the house is paid off. They bought the house in 2000. 30% they probably bought, 10 years ago, around that. And that's probably half of what it's worth today, right? And they've paid that debt off. So the debt's pretty low. And then maybe, 30% roughly has probably got medium or high debt. And so those 30% of people may be struggling, but people will do everything they can to not lose their home. So they'll not go out for dinner. They won't go on holidays, etc. So increases of interest rate doesn't mean they're going to sell the house. They'll cut back on their lifestyle first. They'll work more hours. They'll do everything they can not to lose their property, basically, because they know that's their number one asset. So, yeah, be very careful buying into this higher interest rates property market crash, because, human psychology and human behavior overlays on that. And also the government will as well. If the government starts to see any type of downturn, the government's number one asset is the Australian property market, and they will do everything they can to slow any downturn as well. So, with first-time buyer grants, stamp duty changes, et cetera, et cetera.
Yeah, I think that's true. And I mean, you didn't say this directly, so I don't want to put words in your mouth, but what strikes me, and we've talked about this before as well on the YouTube channel, on the podcast, that property, real estate is where the majority of wealth of Australians sits, including what you said before, where the government, it's kind of bedrock of the economy. So if interest rates rise, and you said they will rise, people need to prepare for that. When they rise, the extent to which they rise will be dictated by the health of the housing market. Now, it's not the RBA's job, nor is it APRA's job to control house prices. They've said that very, explicitly previously. But if there are mass sell-offs, not saying there are, but if there is likely to be a mass sell-offs, then they'll just stop increasing those interest rates, because that is the worst thing that could happen to the Australian economy. I would say, I don't know, I don't have the stats to back this up, but probably out of most economies around the world, especially developed OECD economies, Australia as a nation is probably most leveraged towards residential real estate than other nations around the world. So it's so important that the RBA doesn't overdo it. And I don't think they will. Our governor, I think if we had the previous RBA governor, they might have already raised rates by now, but the current governor is a little bit coy, more circumspect. Some might say a bit more measured. So hopefully that carries on. The other point that you made, Chris, was, high-rise apartments, new house and land packages, all that stuff. So just to kind of, go into that in one level deeper, for everyone who's watching, listening, we're talking about, or I'm talking about when Chris says that, you've got your Western Sydneys, you've got the north side of Brisbane, out past Caboolture, a lot of house and land packages, maybe parts of Logan where there's a lot of concentration of investors from Sydney, Melbourne. They're basically the ones driving those prices up. It's not locals. I'm in Brisbane. Not many locals are buying in Logan more than last year. It's all investors. So yeah, good times, rising tide lifts all ships, but these are great points that you're making, Chris. Just these are the areas, the pockets, Western Melbourne as well, most vulnerable. I'm not saying prices are going to fall all of a sudden, but most vulnerable to rising interest rates. I think what I want to ask you, Chris, is, we're at record low interest rates. 2 years ago, they were a little bit higher. If they rise again by 1 or 1.5%, we're just going back to normal, what it used to be a year ago or 2 years ago. Take that, and then also take the fact that the banks already buffer in 2.5%, now 3% of extra interest rate when they look at whether someone can pay back their loan or not for serviceability. Even if interest rates rise by 1 or 2%, do you really think it's a crisis to the housing market, or is it just going back to normal, something they already preempted?
Look, people live different lifestyles, and some people have got those loans on living expenses that are much lower than what they're actually spending. And, there's just ways you can go through the banking system. So for those people who are living, spending lots of money, living big lifestyles, for example, even if the bank's hedging them and saying, look, it's interest rates going up, they're going to probably have to make cutbacks because when their mortgage starts going more expensive, so that's going to slow the economy down, right? Those type of people. But I agree. I think that this people worried about big falls or looking at it as an opportunity next year after these big falls to get in, I think you're going to probably be missing out, because what you also got to remember is human psychology. So like 2018, top of the, say, Sydney, Melbourne market was 2017. Royal Commission was happening in 2018. Prices were falling because getting access to credit was really hard. Good properties just didn't come on the market. Busy streets, people who were worried about further down falls into the market, they were just getting out because they could. Poorer properties, or people who don't think they're great assets, they come on the market because they're fearful. But the people who've got good properties and quality streets know it's a good asset. They say, well, I could have sold it last year for X. I'm not going to sell it for, X minus 20%, right? So I'm just going to hold on. So what ends up happening in downturns, liquidity drives up of quality assets. And it's actually really hard. And what you'll find in those times, there'll be one quality listing and 10 poorer listings, busy roads, dark, privacy issues, etc. That one property on the great street, all the buyers flock there. And then all of a sudden that property gets competition, and then that property still sells at a decent price because of competition. And so it's really hard to buy quality assets, even in downturns, because all the buyers flock there as opportunists, and also opportunists within the suburb. So, if you know that your suburb's down, you say, well, actually, I've always wanted to live in that street or in that pocket to go to that school. Now's a good time to do it. And so while some people are pulling out of the market, you're also seeing people come into the market. This is not what the media will say, right? The media flips pretty quick. On a Thursday, they can be saying the market's going up. And then on a Monday, after one auction clearance rate's down, they say the market's falling. And so just be very careful around this and just focus on your micro market. Has it got real lack of supply? And, especially the type of property, the better quality, the better, really long-term will pay off. Is there increasing demand, over the longer term? And do I need to sell it in the short term? No. Okay, well, let's just say the fundamentals are sound. Let's just hold it. So, it's very easy to get wrapped up into the media story, because that's what sells a lot of news.
No, absolutely. And it's not actually that hard to, for everyone who's watching and buying a property right now and maybe a little bit scared by what you've said, or their ears have perked up about, the right parts of the suburb, the right pockets you mentioned, privacy, main roads, darkness. All these things are pretty easy to get right. It's pretty easy to avoid a main road. It's pretty easy to buy north facing. It's pretty easy to buy not in front of a big power line or power station. Like, these things aren't rocket science. I mean, they should always be followed, but increasingly so. The other thing that I just wanted to highlight as well is I found that in the last maybe, 4 or 5 years, whether the market is rising or the market is flat or maybe just dipping a little bit, there's still very low stock on market. It's almost like Australians, I don't know the right way to describe it. It's like, they just don't want to sell for various reasons. On the way down, they don't want to sell for a loss. On the way up, they're going to hold out for a higher price. So that is what is really holding up the property market as well, just a lack of supply. And I think, even if demand dips down because of lower borrowing capacity, because of higher interest rates, that supply story isn't changing. It's staying, especially for good quality assets.
Absolutely. So the turnover of housing is actually going less every year, and so that's the amount of properties available for sale is how many properties. That's the supply, right? Doesn't matter if we've got 10 million homes. Amount actually for sale each year, that's the actual supply you can get your hands on. And that's actually falling every year because lots of reasons. They can't afford to do the upgrade, to go to a bigger house, or it's a great street and they say, well, we're happy here. It's not perfect, but we're happy in this suburb. We've got kids going through schooling, and if we did sell, we'd have to pay agents and stamp duty. And, and I just want to pay my mortgage off. I don't want to go into more debt in my 40s, etc. So you're right. People are definitely staying in their homes longer and longer, which means every year supply is getting tighter of good properties. Yes, there's always new stock, right? House and land packages, apartments, etc. That's new available supply. But I'd urge your listeners, which just sounds like you were aligned there, that to not go near that. And that's what will happen is that houses available, that limited supply that are selling, will actually decrease when prices are falling, because people will say, I'm sitting on my hands. I'm not going to rush to the exit. Because if I sell my home, I've still got to go and find another home. So I'm selling in a down market, trying to buy in a down market. Oh, I don't know how much cash I'm going to get. I'm just going to, I can't see any other properties I like because there's no many other properties, and everything just goes sort of a bit flat during that period.
And I think you'll be the expert in answering this question, Chris. Like a lot of in my Facebook group, we have discussions around foreclosures and potential defaults. Same, and every time we post a YouTube video, there's lots of comments saying, well, PK, you've missed the fact that interest rates go up. Everyone's going to have to sell their properties. You're in the unique position where you're writing hundreds, if not thousands of loans. What's your take? Like, let's not go with a wealthy class. Let's just say the average Australian. Is the average Australian stretched in making their mortgage repayments right now? Will they be stretched if interest rates go up by 0.5%, 1%? Like, this is really the clincher of whether there's going to be a sudden drop. If supply goes up because people have to sell, that is what drops prices. Are people in distress right now?
No, so I don't think they can be, because there's situations that, they had to take a new job and now they don't get bonuses, or they've had a kid, now they're on part-time. So they've gone from being, and higher income, their income's dropped, and the living costs have gone up. We know that sometimes living costs, whether it's childcare or whatever it is, right? And so they can be pretty tight, and they can be running a pretty fine line. But I would argue that if something happened, if their interest rate goes up, firstly, they'll try to figure out if they can refinance. And there'll be people in that who get caught out. They borrowed on X income. Now their income's dropped and then they can't refinance. And so then, or their only option, if they start getting, low on payments, they'll do everything. They'll go to family, they will sell everything they've got just to keep the house, because they don't really want to sell the house, especially if there's other sales in the market that aren't, who are rushing to the doors, the exit, because then you'll see some lower prices. And then you'll start to see some fire sales in the suburb. And I do think these will only be in areas where you've got a higher portion of higher people with higher debts. So places like house and land packages. We saw this in the credit crisis in places like Ireland and the US and things like that. That didn't hit across the whole country in every quality asset, but it really hit areas much harder than others, right? So you do need to be worried about it, to be honest. If you're in that position, you do need to make sure that you don't have to sell during that downturn, because if prices do fall, it's going to take a number of years for them to come back. And so, and if you own one of those assets, well, you've got to be really sure it's something you're not going to want to transact in a few years' time. Like you're trying to do an upgrade from that into, something a bit more established closer to the city. I'd probably be doing that sooner rather than later, rather than just seeing how it goes and then, et cetera, and then not being able to sell it for what you want. And then maybe the quality property that you want holds its value and you really lose out. So, absolutely. I do think there's already stats around sort of debt stress, income's not rising, and it is in these areas where you find it's the highest, unfortunately. And so that's where the pain will be first. And it doesn't really hit the real top end. I mean, they don't usually care about interest rates too much. They were all lifestyle driven. The medium end, can get hit, but it's usually only a small portion. It's that 30% of the properties within a suburb that have got high debts. You're going to start to see a few of them come back on the market. Absolutely. Because, they got a $2 million loan at 2% and now rates are 3.5%. And, work's not going as well. And so now I need to list. And so you will see a bit more of a supply coming on there, but that's in areas where there's just a real lack of supply. So you're probably only going to get meeting the market in these areas. So,
and even when you just said that as well, I mean, this is really measured, none of this is obviously financial advice, but that's really measured commentary by you. It's not just all the fancy, glittery, shiny. You're kind of giving some of the downside risks as well. But what I've just taken is you've used an example of a $2 million loan, right? And let's just talk about, like, let's say Brisbane or Adelaide, or where, we're really big on regional areas to invest in, places like Toowoomba and other places like that. The affordability is so strong in these areas that it's almost like the polar opposite to your Western Sydneys. It's almost the polar opposite to your house land package clusters in Western Brisbane or Northern Brisbane or parts of Logan. It's even if interest rates rose by 2%. I mean, I don't want to be talking out of turn, but let's just say Townsville. I'm not saying everyone should go and invest in Townsville, but no one's going to have to sell in Townsville because that affordability is so strong. The incomes are so strong compared to the property price, which is less than $400,000. So I think that's something to be considered, especially for investors looking to where they should buy next. It's probably not a good idea right now. I'm going to go on a limb and say to invest in Western Sydney and house land packages or, et cetera, et cetera. You need to find these areas where structurally the affordability is strong. And, if you're buying a house, especially for investment purposes, you got to have a long-term strategy to ride out these waves. It's a 10, 20-year decision. And I think maybe if I can just ask you one last question, Chris. Rents are rising, right? Rents will likely continue to rise because we have such a social housing crisis at the moment. There's hardly anything for rent. I think I saw someone post the other day on LinkedIn that in all of Hobart, there's only 27 houses for rent, and Hobart's it's not a tiny place. So there's a huge issue. If you're a tenant or a renter, it's hard to find. Therefore, I mean, we live in a capitalistic society. Fortunately or unfortunately, rents are going to rise. How do banks look at that? For investors right now, they know that capital growth should be good if they're investing in the right areas. Rents are going to be going up in most areas. How do banks look at that? Are they going to reward you in terms of future borrowing capacity when that $300 a week rent goes to $400 or $400 to $500? Is that enough to offset the interest rate rise, or how should investors be thinking about that?
Yes, there's probably 2 points. Back onto your Townsville conversation there. Even within Townsville, though, there's two parts to the market, and you can break any city, any town,
100%.
whatever you want down into this. And you've got the aspirational part, which is people who are doing well financially in Townsville. Where do they want to live, right? And as the city grows, there's a growing portion of people doing well financially. It's just unfortunately, like you said before, it's the way it works. Do they want to live in these suburbs? Now, if the things driving that suburb is affordability, it's cheap, then that's usually telling you a lot about the people who are buying the properties, but also the people who own the properties. And those areas will be hit harder if it's driven by affordability rather than aspiration, because you've got different buyers and different owners. Your point around sort of, can you borrow more money if your rents go up? Absolutely. But the thing to be able to build out a multi-portfolio property, and it's not about a number of properties, it's about the market exposure and the quality of that market exposure. But the thing that you need to build that out is income. Income's what you can get a 6 or a 7 times multiple on, whereas rent, the increase in the higher rent, it gets haircut by 20%. So your extra $100 a week sounds like a lot of money. That's $5,000 a year. Well, they're going to get haircut by 20%. So that's only $4,000 a year. And that $4,000 a year, you can probably borrow 6 or 7 times. So $20,000 borrowing capacity. It's not a huge increase. It's a bit of a myth out there that higher rents will allow you to borrow a lot of money. What you do need to do if you really want to build a portfolio is work on your income. Look at ways to, get a promotion or swap jobs to a job that's going to pay you what you deserve, or, do another job or a side hustle or start a business or etc. You can't really sort of just have a lower income and build a big portfolio up. Those days were more like 2014. In 2014, you could leverage off rents because you could borrow 10, 12 times rent, And so if you had an extra $100 a week, that was $5,000 a year. Well, you could probably borrow another 60, 70 grand, right? It's a big difference. And you could leverage, 10 times your income as well, right? So it's not like that today.
Yeah. And I would say that that's really insightful. I don't think many people fully understand that even if you're buying a positive cash flow property, let's say it's a 5.5%, 6% yield, that doesn't get you closer to the next property. Let's in terms of borrowing capacity. We're not living 15 years ago, we can buy 200 properties in 2 years or anything like that. Those days are gone. But at the same time, because it's more strict in terms of those multiples, there's more cushion, there's more stability in the housing market, in the finance sector. So look, I'll probably leave
I
it
definitely
there.
agree with you, because back when it was more relaxed, you did have this quantity strategy. We've seen many of these clients, and they're bought in areas where other lots of investors are bought, and they would come to us. And those areas, haven't performed as well because investors have been dominating the market. And then as prices have risen a little bit, they've realized they weren't going to work, and they started selling. And then you had to have new investors in there, etc. And so those areas were definitely getting unbalanced because investing was so easy. Investors get funneled into an area. So now that things are much tougher, you're creating less problems. Investors haven't been in the market for 3, 4, 5 years, right? Investors always come to the party late. They want to see what did it do last year, and then they come to the party there, whether it's stock markets or whether it's property. And so investors are just now increasing in numbers. And so we have less of these sort of investor gluts like we did back in 2015, which were, And the problem with investor gluts is you've got lots of people about properties available for rent. Every investor means it's a rental property. And so, you don't want to be buying where the market's dominated by investors, because that means whenever you try to rent your property, you're going to have a lot of other properties available for rent as well. And what drives rents up is, like you were saying in Hobart, 27 houses for rent. Okay. So, there's going to be someone who's really keen to rent something, and they're just going to pay whatever. They need something tomorrow. They're going to potentially be homeless, for example. That's sort of the reality here. And that's sort of, obviously you've got the social issue here, right? But that's something the government needs to sort. This is a
100%.
big problem that the government doesn't want to sort out, because it makes too much money off increasing property prices and stamp duty and development of land. And so this is a big problem at a government level that they need to take ownership on.
Yeah, no, for sure. And look, it's the age-old question, but ultimately the only thing that's going to fix that is supply. And you think about our big cities, there's not much more supply. So you got to go regional. We need better infrastructure, better transport networks, all that kind of thing.
Yep, that's true.
We can talk about that for hours. I think last question, I know I mentioned that before, that was the last question, but I think everyone will want to know, everyone knows my views on where it's good to buy, where it's not good to buy nationally, but maybe your views. We're not going to hold you to it. Chris, you don't have to go super specific if you don't want to, but let's say through a lens of everything we've talked about, not following the herd, not just buying where all the other investors are buying, is there will be a glut of investors, and when they leave, prices are going to be vulnerable. All these things that we've been talking about, which are the areas around Australia? And I know markets within markets, and then markets within those markets, and streets and all that kind of thing. But, everyone wants to know this. So where are some of the areas or suburbs or, and any tips that you could give our listeners, our watchers, from a finance perspective, where it still may make sense to invest?
Okay, so you've got your cities, and then you've got your sister cities and brothers that are kind of piggybacking off the capital cities. And I'd say they're the quality regions, the ones that can commutable to Melbourne and Sydney. And then you've got real regional areas where you've got the local community and local, town doing its thing, and there's jobs, etc. COVID changed a lot of things, right? So if you had to be in the city 5 days, then you had a real pressure cooker in the city. But I don't think return to work is going to go back like that. I don't think that's what the talent of today will take, jobs that are 5 days in the city. So I do think this work from home thing is going to shift. But that's a big thing, because I do think long-term Australia is going to have lots of migration. It's our ticket to grow our economy. And so we've got 25 million, let's say now. We're going to have a lot more than that in 20 or 30 years' time. And we haven't got lots of cities. We can't just pop up another Sydney or Melbourne. So our capital cities are going to grow, and you just got to understand how are they going to grow. They're going to grow greenfield estates. You're going to get high-rise apartments, and you're going to get townhouses in the middle ring, right? But within each city, there's sort of pockets that have got maybe nature, or maybe it's the topography of the land, or maybe it's a lot of big houses that have got a real strong NIMBY mentality. Those will be little sanctuaries within our city, right? Where there's no new townhouses, there's no new houses getting built, there's no new apartments, right? Every city's got these. Those little areas, especially if they've got good connectivity to the city and they appeal to young, aspirational, higher income families, will be the ones that perform. The areas where they're going to knock down blocks and build townhouses and new apartments and got bad infrastructure to the city, they're the ones that are going to lag. So you can overlay that sort of mentality within any city, and it's easy to sort of figure it out. I could go and do that in Townsville, within a couple of hours, just by thinking it through. How is this city going to grow? Where's the old money? Where's the bigger houses? So, I mean, what is it? It comes down to price point. So to get into that city or that town, you need a certain price point to get into those quality assets. A suburb that's got fundamental flaws isn't going to just become a premium suburb. It can be near a premium suburb, and so it's nothing fundamentally about it. It's just that there's not enough people to make that a real premium suburb, so it can gentrify. But fundamentally, a greenfield estate won't become a premium place to live. It just hasn't got the same lifestyle benefits. So I think every city's got potential, right? Every city's got these pockets, and as long as it's got strong income and strong local employment, and then people moving there that are on decent incomes, then you've got income growth, actual demand growth, and you've got limited supply. And so you want to buy those properties. I mean, you could buy great spots in Brisbane, you can buy great spots in Sydney and Melbourne and Perth. But to be honest, you are going to be buying a lot more expensive than you were 12 months ago, because these areas, what we've been saying for clients for years, this is where clients were buying stuff in Brisbane at 700 and 900, and now they're like 1.3 to 1.7, or in Melbourne, they're buying at 1.1 and now they're 1.7, and Sydney, etc. So, these are to get into those suburbs in the capital cities, it's expensive. And then in the regions, it is definitely more affordable, but it's got to be the aspirational end of the market, because that's where the money flows. It flows into those sort of properties. So yeah, that's sort of the crux of it. The sister cities are definitely also having a bit of a day in the sun as well, like the Central Coast and Wollongongs and Mornington Peninsula and Geelongs. And so you just got to be very careful buying into these cities at the moment, because it has been low stock and the quality hasn't been great, and they're big prices. And so you just got to, you do need to be a bit careful, because the growth you're talking could be 60, 70% in these places in 12 months, and you just got to be careful that a bit more stock doesn't come on and a bit of demand falls off, and then it just levels out at a much lower sort of ceiling. So yeah.
Yeah. No, I think thank you for that. I really appreciate it. And hopefully all the listeners and viewers appreciate that there's markets within markets, and don't buy at the top of the market, obvious sort of statement. But if somewhere's already grown 60 or 70%, then, just be very careful. And I think the other thing I took away from what you just said is it's okay not to buy $1 million, $1.5 million investment property. Other areas are okay, regional areas as well, but just be careful about finding those areas within those towns which are aspirational. That's where the money's flowing. That's the ones that are being more and more gentrified. I like how you said it'll only take you 2 hours to figure that out in Townsville. That's the reality of it. Anyone can do it. It's not rocket science.
And just think about your buyer. Don't think about, it's easy to rent. Biggest mistake ever, because a good property is easy to rent because it's a great property, so that should be it. It should be quite hard to find, like in terms of the area and the street and where you want to be should be easy, but then actually to find that property, there should be very little turnover of good streets, there's only a few sales. Then so you've got to have a few different areas you look at, but you've also got to just be thinking about, the buyer, who would really want to own this? And ideally you want a double income, higher income family, because if they don't want it, then your demand, the people who, could be the cashed up retiree. So a South Coast, beautiful house near the water or something, that's different. That's the retiree market who are selling out of capital cities. So that's a good market to hit. But if you can't hit that market, then hit those double income, high income families if you can, because they're the ones who have got the borrowing capacity. They're the ones who have got other investments, etc. And then they're the ones who are going to push the price up, rather than a single or a low income family. If they want your property, great. But if they haven't got the income on the cash to buy it, they're not going to push prices up. So that's another thing. Really focus on your buyer and then the quality of that listing in terms of what's on the marketplace.
And so then be patient. If you're looking to buy, it's unlikely you're going to buy within a couple of weeks. It could happen. You could get lucky, but you need to be patient. It's taking, I can say probably safely say for my clients at least, it's taking them at least a month, maybe up to 2 months sometimes to secure a property, not because they don't know where to buy. There's no stock on market. They have to wait for it. But I think we've covered a lot of ground, Chris. I'm super appreciative of you coming on at very short notice. Everyone who's listening or watching, Chris, former financial planner, I believe, now mortgage broker, works at his own place called Wealthful, number 11, according to volume, mortgage broker in Australia. I was going to say in the world for a second, in Australia. And also the co-host of Elephant in the Room podcast. So once again, it's great to chat.
Awesome to come on, and I really appreciate the chat.
Cool. Thanks, Chris. See you guys.
Thanks, mate. Cheers. Bye.